Hello everyone, newborn investor here and welcome to another video. Today we are back with another SPAC merger, Switchback Energy ticker SBE merging with ChargePoint. ChargePoint is special to me because of the opportunity it brings to the table, and if you're interested to know more, make sure to stick around as we're starting right now. Founded in 2007, ChargePoint sells network charging hardware and services to electric vehicle and fleet owners. It now has 4,000 customers and more than 115,000 charging ports. ChargePoint, as the name suggests, produces electric vehicle charging equipment and can be considered as the gas station of the electric vehicle revolution. So what makes this company extremely attractive? We will get to it in a while, so stay tuned. By the way, if you like the video and find it valuable, make sure to hit the like and subscribe button. I really appreciate your support as it keeps me motivated to put in the long hours for making these videos. Alright, let's move on. ChargePoint claims to have the largest electric vehicle charging network and a complete portfolio of charging solutions. It has a customer base of more than 4,000 organizations contributing to more than 115,000 public and private charging locations. With a large network of charging stations, the company offers investors an interesting opportunity to gain exposure to the growing electric vehicle market without taking on the risks associated with an individual automaker. ChargePoint plans to go public via reverse merger with Switchback Energy Acquisition. The deal values ChargePoint at $2.4 billion. The merged company will be called ChargePoint Holdings and will raise roughly $493 million in cash, leaving it with roughly $683 million in total cash after the deal closes. Cash proceeds from the transaction will be primarily used to repay debt, fund operations, and support growth. The proceeds will be funded through a combination of Switchback's $317 million cash in trust account and a $225 million PIPE investment. The deal is expected to close by the end of 2020 and is subjected to the approval of the company shareholders. ChargePoint generates revenue by selling hardware, software, and services, with the majority of revenue coming from hardware. What's striking about ChargePoint's business model is that they don't actually operate the chargers. Rather, ChargePoint sells the charging stations to businesses, employers, and owners of multi-family apartments, and end users pay for usage. To ensure smooth onboarding, ChargePoint has partnered with a network of maintenance professionals to provide customers with high-quality design and installation services. Based on the needs of site owners, the company sets up pricing, access control, administration rights, and advertisements for the charging station. Site owners pay an upfront fee and are charged monthly for software and support. ChargePoint makes another chunk of its revenues through its ChargePoint as a Service program. Through this offering, customers get access to smart solutions at a reduced cost and customers are charged for their usage. ChargePoint as a Service is the only solution that includes free installation, which can amount to large savings for its customers. The company also offers a mobile app through which drivers are able to find and access chargers and extended ChargePoint features. ChargePoint forecasts to generate a revenue of $2 billion by 2026. Management's always tried to paint a rosy picture by their impressive investor decks and forecasts. But what's the likelihood of ChargePoint getting to that number? Based on the company's last year revenue and electric vehicle adoption growth rate, I think the company is well positioned to meet the revenue expectations. Even though greater electric vehicle adoption translates to higher revenue, that is not the only factor that affects revenue. Keeping the expense low will also improve margins significantly. For ChargePoint, the majority of its expense is related to setting up charging stations, and it's a one-time expense. The company already has more than 100,000 charging locations, and as they approach their infrastructure goals, margins are set to improve. The company also expects to reach a gross margin of 42% by 2026, which is an impressive margin. Another striking factor is customer retention and the cumulative spend. ChargePoint customers tend to spend 14 times more in 3 years. What does that mean for the company? It simply means revenue generated from a customer at the end of third year is 14 times more than the revenue collected from the same customer in year 1. This is an excellent testament to ChargePoint's product and services. ChargePoint is primed for growth with increasing electric vehicle adoption. Climate change is one of the pressing issues that humanity faces today, and officials are taking certain aggressive steps to tackle climate change. The latest one came from California Governor Gavin Newsom, who signed an executive order banning the sale of new gasoline-powered cars by 2035. This would mean California has to embrace electric vehicle adoption to the likes of never before. As more states move to electric vehicles, demand for charging networks like ChargePoint should increase dramatically. With ever-growing networks of charging stations in the US and abroad, ChargePoint is well positioned to emerge as the winner. With 73% market share, ChargePoint is killing the competition. They dominate the market, and to me that is a great moat. Additionally, ChargePoint operates a capital-intensive business, which makes it tough for new players. The company over the last several years has built its infrastructure and is looking to use the funds from the merger to expand to other markets. ChargePoint has made it extremely difficult for its competition, even if they want to play the catch-up game. While the majority of its sales currently come from hardware, ChargePoint plans to significantly ramp up revenue generation from its other key sectors like recurring software and services. Not only will this shift improve margins, it will also likely make it even more attractive to investors as they search for more high-growth firms with a subscription component within their models. So for these reasons, coupled with the cheap price, ChargePoint to me seems like an attractive long-term buy and hold, and this is solely my opinion. As the merger is not complete yet, you may have to trade ticker SBE if you want to play the stock. I'm currently long on ChargePoint and will be looking to buy dips as long as the stock stays about $12. Now, I would love to hear from you guys. What do you think about ChargePoint and its growth potential? Leave a comment below with your answer and I will be sure to follow up with you. Also, if you liked this video and found it valuable, make sure to hit the like and subscribe button. I really appreciate your support. So until you hear from me again, stay safe and thanks for watching. Bye.